Good morning, ladies and gentlemen. Graeme Holm here, aka the Money Mentor, with the always amazing and interesting and very, very blunt but direct and funny, but you know what's more important, always accurate, Dr. Andrew Wilson, Chief Economist from My Housing Market. G'day, Doc.
Yeah, thank you very much, Graeme. I appreciate the positive sentiments there regarding what we do here. And
flattery will get you everywhere, apparently, Doc.
Oh well, and also, bribery is helpful as well. So I'll fix up later, Graeme.
But you know what's important in that intro, Doc? Always accurate.
Well, we try to be, and it's a plan because we just don't sort of throw something out there, and we're not after clickbait. We're after people who want to make rational decisions based on clear insights and insights that are based on a data stream and logic, et cetera, and not just, an hysterical, activity in trying to gather attention. And, it's important in property particularly because it's a big exercise, securing property or being involved in property. And you want to at least try to make sure you make the right decisions. And that's what we try to do here, is provide people with the background for the right decisions, and not, based on what happened 6 months ago or 12 months ago, but as much as possible based on what's happening now. So it is a very interesting period. Of course, we're leading up to the big day in November, which is the Melbourne Cup Day. I mean, not really, but
I was going to say the other big day we might have, Doc, in November. Let's be really clear, and I don't know whether we're going to agree or disagree, but I think we're going to have a rate rise.
Well, it's interesting, Graeme, because we're going to discuss that today. And certainly we've had some important data out this last week, and that's the labour market data for the month. And, despite all the wishing and a hoping and a praying, the labour market continues to rock along on 8 cylinders. It's just roaring along. And that wishing and a hoping and a praying is coming from the Reserve Bank, looking for the slightest sign that higher interest rates since May last year, and what's that, 18 months ago, have worked. Well, they haven't worked. They haven't worked at all. Then we're now seeing, and we'll have a look at some insights into the minutes from their last meeting, Graeme. And really, it's just a smack of desperation now that they're starting to look at other factors, hopefully providing them with the outcome that they want. And that's that, the economy is starting to cool off. It's not cooling off. And despite all the sort of gobbledygook they're coming out with now, in my opinion, in relation to looking at other measures. So it's like, well, we can't, have our position supported by the usual data set. So let's look at some other ones. Maybe they'll help us out, right? Really, this is just a little concerning. And it just adds to that, longer term period we've had from this Reserve Bank in terms of inaccuracy, and we're in that phase again. As I said, we'll look at that data. But yeah, next Tuesday week, of course, is Melbourne Cup Day. The race that stops a nation, et cetera, et cetera. It's a holiday in Melbourne. But the big day really is about Melbourne Cup Day being the day that the Reserve Bank traditionally always meets the first Tuesday in November, which is the date of the Cup. But it's also, Graeme, when we look back in history, it's always been a moving day for interest rates. Well, not always, but it's been a particularly favoured day for the Reserve Bank to act. And maybe they're just setting the scene to act this year after having paused for 5 of the last 6 months. Now, some of the things in the narrative have changed. Maybe we've now shaken off the influence of the previous governor, and he's gone. He's gone. See you later, mate. Out the door. And we've got our new governor now. So maybe she's going to exert perhaps a little bit of a different focus on monetary policy. Maybe not. But I think the signs are certainly increasing that we will get a rate increase on Melbourne Cup Day, which, as I said, has been a favoured day for Reserve Banks to move interest rates, either up or down. Certainly no chance of a cut. But I would have thought the case, and we've been really promoting this for some time, that the case is strengthening for another increase. And really, if we do get an increase, there's going to be some questions about why the hell did we pause for so long when there was just no sign. And it was like, wait and see. Okay, wait. How long do you wait and see? Well, we wait and we've been waiting and seeing for 6 months. Nothing's happened. In fact, if anything, the economy is getting stronger, we've had inflation ease, but that's been because of the post-COVID adjustment from goods, with suppliers catching up with all that demand. But now we've got services costs going through the roof, as yet we haven't had a wages breakout, but certainly we've got this very strong labour market. And I would have thought the way to control inflation is to stop people spending. And as we know through history, and that's what the policy is all about, the way you stop people spending, unfortunately, is to, lose employment, is to have a higher unemployment rate. And, we've just got this massively low unemployment rate.
Let's rip into that, Doc, because you've got some data this week. You told me you were going to rip into the labour market for us, and then this cloud cuckoo banana RBA sort of setting the scene. Maybe it's not crazy. Maybe they're just previewing where they're heading here with the commentary. So let's have a look at it.
Well, I think the RBA will concede that it's an imprecise, science. It's not a science, probably an art, I'd say. And, they don't have the answers, but we need those that do have the answers, or more of the answers, to be making decisions in monetary policy. And I cannot see the justification for pausing in rates as they have, particularly, they can say, well, the US paused. Yeah, okay. But the US has half the inflation rate that we do. And it has, 1% higher its interest rates. So it's, further, it's matured more in terms of controlling inflation than Australia has. Let's have a look. My housing market's latest data. We're all about the current state and future prospects of housing markets, Graeme, as we always discuss. And as you said, we get it pretty right most of the time. That's because we take a logical view of the world, the housing market, and we use a number of data, sets, different data models to justify what we're saying. So labour market remains strong despite higher rates, mate. So another big month for the labour market. We actually had a fall in the unemployment rate. This is why they're saying, don't worry about the unemployment rate. You know what I mean? Because it's just not heading in the right direction, mate. It's
don't
just
worry.
not where
everyone's got a job. They're getting paid more, so let's just not look at that factual data at all.
Yeah, it's not. So, what are we doing? Let's just go on a holiday or something. I don't know. Well, they had an interest rate holiday for the 5 out of the last 6 months. So the unemployment rate, Graeme, actually fell to 3.6%. So not only is it, it's weakening, we can sense that it's weakening. No, it's strengthening. So unemployment rate falls to 3.6%. This is a seasonally adjusted measure, so we can't blame seasonality to it, although there are some seasonal factors, as we've discussed, that may be impacting the ABS data through the post-COVID era that we have to sort of catch up with. But we also had another increase in jobs, up by 7,000, not as big as the number we had, which was massive last month, but we had another month higher, Graeme. So another rise in the number of people in work, following the huge number we had increased the previous month. So the trend is on the positive. But we had a really big fall in the number of people out of work, Graeme, 20,000 fewer unemployed.
Wow.
So, it's more people with jobs, fewer people unemployed. So,
it's also 20,000 people extra with money to now spend, Doc, that didn't have money to spend.
That's right. More demand, So no wonder this data isn't sitting very comfortably with the Reserve Bank, because, they're waiting and seeing if interest rates work. They're telling us that interest rates have a lagged effect. Well, what sort of a lag do you need? 18 months? For goodness sake. I think this is why they're probably going to say, well, look, we're going to be in a bit of trouble if we don't move again, because these questions are going to be asked. Well, what are we waiting for? Unless inflation takes a sharp downward movement, they can't point to anything that's been a success with their monetary policy to this point in time. Now, the participation rate eased very slightly, 0.2%. Of course, last month, which was August, the August result was a record high, which was at 69%, which was a record all-time participation rate high. So the participation rate measures the proportion of those that could work who are actually working, right? So it's the highest proportion, near the highest proportion of potential workers that we have actually working, so that's great. So we're getting more people into the workforce than we've ever had before in terms of a proportion of the potential workforce. And New South Wales still the state labour market leader. So we're going to have a look at the chart here, Graeme, and I think this is very interesting. If we look a bit closely at that. So if we go back, can you see it's just sort of bumbling along there? The latest trend, it's just sort of bumbling along. I'm a little concerned about it just it looking a bit even, those patterns from month to month. See how that's sort of an even bump from, and that just maybe tells you that there's some underlying noise, as they call it, that's not being accounted for, and that could be a problem with the seasonal adjustment. But forgetting that, it's just flat, mate. Look at it. It's not going up. That's what they want, is to see it rising. It's just flat, and that's since interest rates increased. It's stayed the same.
If you take that little seasonal or cyclical bump, Doc, there's something in there, that heartbeat. It actually is just bang on flat.
Yeah, flat. So what are we waiting to see? That's pretty obvious, isn't it? I mean, there's just no upward trend emerging in unemployment. And it's not just the trend, it's the fact that it's so low. It's bumping along the lowest we've ever had, right?
And maintaining that record low.
And it's maintaining it. And we're getting more people in the workforce, increasing jobs. We're getting the highest proportion of our potential workforce working. And we're losing tens of thousands of people who were unemployed, who are working again. Oh, please, for goodness sake, where is the logic here? Seriously. Let's just go up 0.5% and be done with it, to scare people to stop the spending, to slow it down. Oh, look, Graeme, this is the problem, is when you stop early, you then allow people to recover to some degree the capacity that they've lost through higher interest rates, higher wages, whatever, offsets that, over the period when you're pausing. So it means you can't just go back and say, oh, well, we'll go up 0.25%. People go, oh, well, that's a bit of a shock, and another 0.25%. Oh, well, this is 0.25%. And it doesn't have the impact that monetary policy is designed to have, and that is to not just to slow the capacity to spend down by having to pay more on interest rates, but also the aspect of people being a little concerned. So they hunker down and think, oh, I better take it easy here. We don't know what's going to happen. But they've lost that sort of momentum from last year, people thinking, oh, this is a bit scary, because they didn't continue it on. And, as I said, the US's interest rates are 1% higher than Australia's, Graeme, 1% higher, but their inflation rate is 2% lower. So they've certainly got their position under, and they're concerned. They're talking about a November interest rate increase as well. And yet their position is a lot better than ours in terms of where their inflation rate is, much lower than ours, and also their interest rates are much higher than ours. So, you can't compare really, and we've had this discussion, what happens between economies to some degree, but certainly, there's a real analogy there between the two, I think. And that, again, is pointing to, maybe they push the button on Melbourne Cup Day. And as we can see there, New South Wales still heading the charge. And look, this tells the story. 3.3% in New South Wales, Graeme, and which is exactly the same as a year ago. So over a year, New South Wales has maintained this super low unemployment rate, right, over the year at 3.3%. So it hasn't, higher interest rates haven't affected the New South Wales or the Sydney economy.
Same for Melbourne, same for WA.
Yeah. And only Queensland really has shown some easing. But of course, Queensland's had to absorb all that migration over the last couple of years. So, but still, who's sneezing at 4%, for goodness sake?
No.
That's a fantastic result. I mean, we're looking at 3.3, and it's just like, this is amazing. And it's steady. This is the point. It hasn't moved in a year, right? Despite 12 interest rate increases. So, it's, as I said, I think when we're speaking logically, there's some real issues going forward. And I think, unless there is a real shift upwards in a decline in our labour market, the Reserve Bank's got to act, mate. It can't just keep sitting there saying, we'll wait and see, Well, how long are you going to wait and see until something happens? So they've been hoping something will happen, and nothing's happened. So let's have a look. As we've discussed, maybe the RBA is set to raise rates. We've already sort of discussed that likelihood, possibility.
Well, Doc, just on that, I just want to cover this for the opening of this topic here. If the Reserve Bank, if the RBA does increase interest rates again, borrowers need to be aware of the serviceability buffer, which is why we did not have a mortgage cliff. We've covered this in the last few weeks, Doc. If we're at 6% now and we go to 6.5, the bank has to assess their lending capacity 3% higher at 9.5. So if we do raise rates and people are thinking about upgrading, downgrading the home, a lot of people will be pushed out of the market capacity-wise. So this is serious data here, guys.
Yeah, and this is what the Reserve Bank wants to do. This is about quelling demand, and they've just completely failed, really. And despite what they're trying to say, now these are the minutes from the last meeting, Graeme, and I think that they're very revealing. And I'm not going to sort of go into it in huge depth, but I think there's a number of really important points here. But we want to get through this, with making those main points. The first thing is, well, at the last meeting, the RBA said that they reckon the labour market's reached a turning point. They reckon it's reached a turning point. This is before this data was released last week. Really? A turning point? Well, not on last week's data. Give me a break,
Was their turning point a roundabout and it turned and just went back all the way around and continued on?
I'm getting dizzy, Graeme. We're going around and around. But anyway, so it said that apparently the Australian government has released an employment white paper, which is a discussion around the employment market. So in that white paper, they emphasise, the government, that you need to monitor a broader set of indicators beyond the unemployment rate. So here we go. So, okay, unemployment rate's not working for us. Let's try to find something else that is working.
Let's just ignore that because that doesn't tell us what we want to do.
That's right. But we've seen there, when we look at the trend, it's just boom, 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 boom along the bottom, right? So it's obviously, that's not what we want to see. We want to see it rising. So anyway, so they're using this, the Australian government white paper. God knows who produced that. Where they've said, we've got to use a few more indicators, not just the unemployment rate. And that says, well, that's consistent with what we're doing. Yes. So they're using that white paper to justify the fact that they're looking for other measures. So let's not go too deep in this, but what they're saying is there are other measures that they can look at, which are more sort of minute, granular measures of the labour market that they think might be justifying the fact that demand is falling. Now, one of them is underemployment, right? So there's a measure of underemployment which measures the people aren't getting as much work as they want, right? So they might have to work part-time, they want to work full-time. So there are measures for that, and they're saying that some of those measures are showing that that's declining, that there's more underemployment. Okay. Now, the other one's medium-term employment. So that's those unemployed for 1 to 12 months, right? They reckon there's some signs there that that's increasing. And also they're looking at the hours worked. They reckon there's some signs there that hours worked are falling as well. So they're putting that all together and they're saying, that might be some signs. We'll look at that our interest rate policy is working. Yes, the unemployment rate is the lowest on record. Yes, it's been there for a year. Yes, there's no sign of it changing, but all these other, sort of peripheral measures are maybe showing us that it's working. So they're trying to use that as justification. This, of course, was before the latest data came out with that, another low unemployment rate, jobs rising and unemployed declining sharply, whatever. And it's also saying that to add to that, business surveys and these famous business surveys that they do and information from their liaison program, which for goodness sake has been so wrong, particularly about wage determination. They use that to tell us, what they reckon wages are going to do. And they've been wrong in regard to that insights, their little private liaison program with businesses. And they're trying to say, that's showing us that there's an improvement in the availability of labour. So you can see what my point is, that they're putting together all these other bits and pieces to try to justify the fact that their interest rate policy maybe is starting to work. And that's before we've seen this very, very strong, very, very strong result for September. So for me, it's a little disingenuous. To me, it's like, it almost smacks of desperation, Graeme, looking for anything to justify their position. And a discussion paper from the government supporting that they should look at other measures. Hey, it's about the unemployment rate. And if you go back and look at the unemployment rate versus the inflation rate during other periods of tightening monetary policy to curb inflation, you can see that inflation only falls when the unemployment rate rises. So sorry, guys, you're not going to get away with that one, at least with Infinity and My Housing Market. So
I reckon, Doc, if they went back and watched us for the last couple of years, we'd be a more accurate liaison partner.
Yes, very good. Very good.
And we're putting this out there for free.
That's right. Okay. Anyway, it's just, I don't know what it is. But so, again, we had a bit of the change in their narrative. Output growth, that GDP, improved better than expected. But then again, they mentioned, and they've got to mention this, Graeme, they're crapping on about the GDP, the per capita level of GDP and the per capita level of consumption. Now, I don't know if I have to put this into single syllables or two syllables to make this clear. The word is migration, right? Migration. The reason we have had a decline per capita in GDP and consumption is because we have had hundreds and hundreds and hundreds of thousands of people coming to live in Australia. The total level of consumption of GDP is rising, right? It's just not rising per capita because we've been flooded with people.
With more people.
We got more people. Hello, RBA, gee.
How is it that these people in these roles, Doc, can look at a set of data and skew it for a particular preference, agenda, be naive, possibly negligent even, and not factor in the influx of people that will affect those? Oh, man, sorry.
And the point is, you look at the levels of GDP per capita, and they're miles ahead, even though they fell over the June quarter, they're miles and miles ahead of where they were pre-COVID, right? And that's the whole point, and the only reason they've fallen per capita is because we've had this massive surge in people coming into the country as a result of our borders opening up. So, that's the reality. And that's why our economy is still booming, mate. And we don't have higher unemployment because all these factors are not impacting the real economy. And that's people with jobs, which is increasing, and higher wages. And I mentioned just again, we've had an upward revision in GDP, and which has ended up 0.5% higher than forecasts. Again, we're getting this continual thing from the RBA. Oh, their forecasts were wrong. Oh, our forecasts were wrong. And it's really almost across the board. They mentioned rents again. We've done rents. We did our rent report last week, Graeme. And they admit that, conditions remain very tight and they're going to stay there. And they're admitting that, it's about also the high level or the low level of housing starts, right, of building approvals of new homes coming into the market relative to population growth. It's not population growth. It is population growth, but it's migration, right? I mean, we're not having a surge in, baby producing. It's people coming in, from outside. And as they say, they think that rents will be an ongoing source of inflation over the year ahead. And higher interest rates aren't going to fix that one, mate. We need more property. We've discussed that. They also mentioned the turnaround in the established housing market, once again admitting how wrong they were. Upward revisions to earlier data. Hey, where's these revisions coming from? This is what we say at My Housing Market. We produce data today. We don't have massive revisions in our data, and yet the RBA is using data which has to be revised. So how can you trust the housing market data that the Reserve Bank is using if it has to be revised, and then they have to discuss the fact that revision has altered their view of the market? Can you get some decent data, Reserve Bank? What's going on here? Why are you getting these revisions in data?
Maybe it's not the data. We're getting the same data, Doc. Maybe it's the people that are processing the data and how they choose to interpret this dribble that they're providing.
Well, as I said, that's a bogey word, revisions, because it means you can't trust the data. It means the data might change, And I mean, all data changes as more observations come through, but it's the level of change. If the level of change is such that it changes your view of the market, then it's not, it's not an appropriate revision to the data in the first place.
That's kind of like saying I want to lose weight, Doc, and I eat KFC, McDonald's every day. Oh, hang on. I got larger. I might do a revision to my meal plan. Hello?
Look, as we always point out, Graeme, it's important to have accurate and robust data, not just single data sets, but a number of data sets that point you in the right direction. And that's what we do, and that's why we get it right most of the time, if not all of the time. They mentioned that listings had picked up in Sydney and Melbourne. It's spring. What do you reckon? It's spring. Of course they've picked up,
They pick up every spring.
Listings have picked up, and that's amazing, isn't it? And hey, members also noted that the stronger than expected, I was going to underline it, but I'll put it in capitals or put it in bold, recovery in the established housing market, right, might provide some support to consumption in the period ahead. Oh, my God. You know what we're seeing here? We're seeing, we got to watch that housing market. Maybe we have to put a brake on the housing market. Oh, it could be dangerous. This is back to the bubble crap that got previous Reserve Bank governors into so much trouble.
It'd be like going, Doc, we need to put rates up on investors to cool the market, except that would ruin life for tenants because rents would go up. And we know that didn't work. It didn't work in 2018.
That's Groundhog Day. That's just repeating what they've done before. Talk about shoot yourself in the foot again. But of course, higher rents means higher inflation, and that's what they're trying to cure. They've already mentioned about rents working their way into inflation. Now they're talking about, maybe, they mentioned in their notes that they in their minutes that we don't want to be controlling the housing market, but so the narcs who were still worrying about this absurdist policy about the housing market bubble, which has been an embarrassment to policymakers, really, who've taken it on board for the last 2 decades, because it's just complete fairyland stuff, and now buying into it again, even though they qualify by saying, we don't want to be controlling the housing market, even though prices are still below where they were at their peak last year in Sydney and Melbourne. So how can you start talking about bubble stuff and controlling the housing market and its impact on consumption? This is very concerning from the Reserve Bank that's just come through a period of really severe questioning of its capacity and competence. And here we go again. So, all right. And they mentioned the asset prices and they said, housing prices alone won't warrant tighter policy. They're worried about the associated rise in household wealth, and particularly if turnover picked up, and that a rise in house prices might be a signal that the current policy stance was not as restrictive as had been assumed. God, how often do you want to get it wrong, guys and girls? Because, again, they're saying, but what the implication is that they've been raising rates to control the housing market. And yet they've got their predictions on the housing market so wrong that it is a total embarrassment to them. It
Well,
must.
Here's a thought process. Is the RBA trying to help with monetary policy and the economy at large? Or are they absolutely blinkered and have completely effed it up and they're only looking at the housing market all the time?
Well, are they bubble lights?
Yeah.
Are they bubble heads? Are they bubble lights?
Hubba bubba housing market's all we look at. Oh, we're going to watch that housing bubble that's never happened. Oh, don't worry about unemployment. Don't worry about the labour market. Don't worry about that. Come on.
I can see their brains expanding in big bubbles of.
It's like that. What's that? Coneheads, that movie? Just bubble heads in the RBA board.
I think we're getting beyond it. Anyway, again, nonsense about the housing market. And my God, if that plays its way into monetary policy, which it's had done before because the previous jurisdiction kept rates on hold for too long because they were worried about this housing market, outbreak, problems, imbalance. And we had a record period with rates on hold because of those concerns from the previous governor who got it so wrong about the housing market. Well, what's he doing now? Who knows? But and then they had to reverse gear and drop rates sharply in the back end of 2019. So the economy as whole suffered because of the obsession of the Reserve Bank, in my opinion, with housing market imbalances, which has never occurred in this country. So in the end, they concluded that they need more information. So they're saying that. So they've said all that, which is like, yeah, it's working, and all poor old housing market, blah blah blah. Now they've said, but we haven't had enough information, and that prior to the November meeting, we would have additional data. As well as, here it is, a revised set of staff forecasts. So they're going to have a revised set of staff forecasts. Well, gee, I hope they're a lot better than the previous set of forecasts, guys and girls, because you'd want to be doing a lot better than what you have been doing. And the very fact that you will start raising rates again is an indictment on your conduct of monetary policy, in my opinion. And, of course, they have said the usual finishing off that some further tightening may be required. So this is their get out of jail phrase, just in case they have to put it up, and that they have a low tolerance for for a slower return to inflation than what they've predicted, and that they're firmly committed to reducing inflation. Now, the other thing that was interesting here, Graeme, is that they didn't mention their target this month. Normally in the meetings they say that their target is by the end of 2025. They didn't mention that's where they hope to get back to inflation. So they put that little one to one side. So I think, we may be in for an interest rate increase. So we've had a real bashing of the Reserve Bank. It's been an RBA bashing day to some degree, but I think it's been logical. I think it's been, more or less rational. But I do think, we wouldn't be surprised. I'm not saying it's going to happen, but I'm saying that that there's a fair sense there. And, we've got to wait for the data to come out, and especially these staff forecasts, secret business, that are going to come out, which may influence them to raise rates. So let's have a look at the auction market to finish off. We'll see what happens the week after next, Graeme. I'm excited to see. And we'll have our latest set of house price next week. But auction markets, some good results, I thought, given that we've had a couple of, the weekend before was a little bit easier in terms of markets. We were discussing the fact that perhaps, we're certainly off our yearly highs in terms of clearance rates, but the market sort of bounced back a bit on the weekend, Graeme. I think there were some pretty reasonable results, even though we had a surge in listing numbers. So numbers up in Sydney, Melbourne, big numbers in Brisbane, big numbers in Adelaide, down a little bit in Canberra, but some good clearance rates there. Sydney, just about where it was the weekend before, just under 73%, good result generally for sellers. Melbourne was up just under 70%, with big numbers, just under 1,000 auctions. Of course, it's Super Saturday in Melbourne this weekend, which is the pre-Melbourne, it's Derby Day. It's the pre-Melbourne Cup holiday weekend.
Post-AFL, pre-Melbourne Cup, blah, blah, blah.
So it's the last Super Saturday of the year. So we'll see how that goes. And normally it actually can be a good day because there's for clearance rates, because even though there's going to be a lot more auctions, there'll be more choices for buyers. So a lot of buyers have been waiting for that special property will be able to act. Brisbane, good result for Brisbane there. Bounced back 66% clearance rate on high auction numbers. Adelaide's been a bit of an underperformer recently. We're used to those 80% results in Adelaide, Graeme, but it was down in the 70s again.
A lot of stock, but it's doubled nearly in stock volume.
Huge, mate. Huge weekend for listings in Adelaide.
So that's a strong result given the double in listing numbers, I think.
So the actual number of sales would have been similar to what it is weekend by weekend. Canberra has just picked up a little bit in recent weekends and now tracking above the 60%. So if we look at the trend, Sydney holding there above 70 so far in October, but below where it was at its peak in May and June, that catch-up market where it was pushing 80%, but still a seller's market, I would believe, generally. Melbourne holding up, in fact, tracking higher than September. September was a quiet month for Melbourne, but there was a lot of distractions. School holidays, of course, and the AFL issues there distract the market, but just rising a bit over recent weekends. So we need to keep an eye on Melbourne, but holding up at the moment. Brisbane steady-ish at the moment as well, around about where it was over the last few months. As we mentioned, Adelaide's down, which is interesting. It might be a stock issue with pulling Adelaide down. And Canberra just picking up a little bit now, which is positive for that market compared to the previous market. Of course, the auction results are available of Saturday night, the capital city results, and Sunday morning we will send out on my LinkedIn account the national auction market result, which has the breakdowns for regions in Sydney and Melbourne. As we usually finish off with our ad for the app, the My Housing Market Infinity What's My House Currently Worth app. If you want to get hold of that one, take a picture of the QR code, get onto Infinity. They'll tell you how to access that. It's a great little app, tells you what's happening in the market right here and right now in terms of number of properties for sale, number of properties for rent, the median price, the high price, the low price, on a suburb-by-suburb basis, Graeme. I can see you're excited about that.
Oh, yeah. Bedrooms, suburbs, types, I love it.
Number of bedrooms, property types, you can do it all there. So get into that one, but you've got to go through Infinity to get hold of it. And it's really worth it if you want to keep up with what's happening in the market on a day-by-day basis. And with all that data, with a real data model. So next week, October home prices, Graeme. So let's what's happening in October. A little bit of a secret, Graeme. We've seen over the last couple of weeks, and we track prices here on a daily basis, just starting to pick up a bit after quite a September. Still positive, of course, in September, but we mentioned how the rate of growth had eased, but now we're starting to see some actual uptick in the rate of growth in some of the larger capitals, which is quite interesting. So we'll have a look at that. September CPI, inflation rate, that'll be very important for the Reserve Bank, of course. Also the September retail trade, and as usual, the latest weekend auction results. So look forward to discussing all that. It's been a big day today, Graeme, hasn't it?
It has.
Yeah. Will we see an increase in interest rates in November, or will they hold their powder dry and wait? Because, see, the other point about November, Graeme, is really if they're going to move, November's the month to do it, you see, because there's still some time for it to work.
Yeah.
Right? Because you've still got, it's no use. What's the point of cutting it in December? Because people are in holiday mode. But November's also Black Friday month, you know what I mean? So they want to quell spending on Black Friday, right? It's a big month. November's the biggest month of the year for sales now, for retail sales. So if they're going to move, it's logical that they will move November to have the maximum impact, right, by having still some time in the year for it to work its way into the system and also to impact those retail sales for Black Friday. So I think we're making a reasonable case here. So we'll see what happens, shall we?
Let's see if logic applies, Doc, and reason applies. But stay tuned, ladies and gentlemen, and we'll chat about it next week.
And if it does happen, of course, once again, you heard it first here.
Absolutely. Thanks, Doc. Have a great week.
Thank you, Graeme.
Thank you.